Hi everyone, welcome to this time's Scrolling Finance. So last week was a tough week for everyone who works in the bond market. The main reason was that the financing situation wasn't getting any better generally. A lot of investment agencies borrowed money over the price of 1.8%, and there wasn't a clear sign of losing funding condition. So has the cutting policy interest rates expecting inverted? Has the PBOC changed its mind? And more importantly, what is the most suitable strategy for this kind of mess? Well, let me tell you the following story. First, for news and fundamentals, some news and rumors came out. One was from Reuters in Monday. Several financial agencies lowered their expectation about a cutting policy interest rate in fourth quarter, according to some surveys. And another one said that the PBOC convened with some banks to discuss the financing issues and increased the volume about bailout reverse repurchase. Meanwhile, the A-shares market performed well during the past week, since the DeepSeek encouraged the risk emotions of investors. So overall, equity market performed better than bond market in the last week. In terms of actions of investment agencies, agricultural and commercial banks bought long-term bonds mostly, whereas funds sold most of them. The PBOC posted Q4 China monetary policy reports on Thursday. Let's make an effective briefing. The report emphasized four things. First, we accomplished whole year economic growth target successfully, which is true since we got a 5% GDP growth rate year-on-year statistically. Second, monetary policy is moderately loose. The PBOC will adjust and optimizes the strength and the rhythm of the policy according to the timing. Well, for now, no clues about cutting policy interest rates, no clues about losing funding condition, so I guess now isn't the right timing for that. Third, enhancing the resilience of foreign exchange market and resolutely guarding against the risk of exchange rate overshooting. This stated the determination of the PBOC to maintain the stable position of renminbi exchange rate again. So one more bad news for financing condition of the bond market. Fourth, making a good balance between interest rates in the domestic market and exchange rates in the overseas market. Cutting interest rates may be conducted on time. Well, the last part of the sentence ensured there still has a plan about cutting interest rates. So overall, the total report didn't show much useful information. It doesn't have a clear orientation or guide effect, so it hasn't affected the bond market much. Second, funding condition was tight generally. Although it got a little better in Tuesday afternoon, but the strength of losing funding condition was weaker than expected. The attitude of the PBOC towards funding was still strict, which was the main reason that prevented bond yields from going down. The total funding condition was too high to making bonds investment profitable. Comprehensive financing price must around 2% for investment agencies. The bond asset that has a very high interest rate to cover the financing price was scarce or even doesn't exist. The FLCC business is on its turn now. Third, for bond investment strategies, now as I estimated, based on a hypothesis that the PBOC already did a 25 basis points cutting interest rates by other subtle way, such as conducted 1.4 trillion yuan bailout reverse repurchase, bought 300 billion yuan treasury bonds, and implemented MLF by 300 billion yuan. The use of short-term bonds already increased back to a regional level where the PBOC thing is supposed to be. That level is also under the position of mid-December of last year. But yields of long-term and ultra-long-term bonds were over-decreased by 10 to 50 basis points compared to that time. So now the bond yield curve was pretty flat, which means that you can take short-term bonds as a rebound. Although the negative interest income will bleed you badly, but it also has less increasing risks. So above contents are this time Scrolling Finance. Well, I can't make sure whether the cutting policy interest rates expectation has inverted, but I was saying that the pace of that isn't the expected go straight away as time goes by. Especially take the exchange rates factor into consideration. Long-term bonds give you more space to induce the negative carry and more risks on increasing yields adjustment as well, while short-term bonds is opposite. Less room for taking negative carry and less risk on increasing yields adjustment. So as always, if you want to know more useful financing information about the Chinese bond market and the economic situation, please like, share, and subscribe. I will always be here, share my understanding and experience, and waiting for you. So bye guys, until next time.